This is Macro Horizons, episode 312, Dodgin the DOGE, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 24th. As we contemplate the extent to which the Department of Government Efficiency will ultimately impact the labor market, we're reminded of the time-tested wisdom that when you're unemployed, the unemployment rate is 100%. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had very little fundamental data from which to derive a trading direction. We did see initial jobless claims for non-farm payroll survey week, which came in at 219. Constructive for the outlook, to be sure, and interesting given that the Department of Government Efficiency has been making layoff headlines recently. Perhaps the most notable developments came from monetary policymakers, specifically in the FOMC minutes in which the Fed openly discussed ending QT. Now, it follows intuitively that the balance sheet rundown would eventually end at some point. What arguably caught the market somewhat off guard was the fact that the timing of the end of QT was linked to the debt ceiling and indirectly the rundown and eventual replenishment of the TGA. So with this backdrop, it wasn't surprising to see the front end of the market perform well. When we view the recent price action and add in the detail that the Fed is also talking about either reducing or completely eliminating SLR, then one should not be surprised to see the ongoing widening of swap spreads. Cash outperforming swap rates in a moment where Treasury issuance concerns have lessened, and of course the end of QT all benefit cash treasuries on a relative basis. Within the FOMC minutes, there was also a discussion about aligning SOMA to more closely reflect the average maturity of the Treasury debt outstanding. Doing so would reduce the average maturity in SOMA by roughly 3 years. Now, clearly, this has benefited the front end of the market, 2s, 3s, and 5s in particular, although we'll note that it's important to keep in mind that the Fed is most likely to affect such a change by simply reinvesting the roll-off of the portfolio in a specific way to achieve the goals of a shorter duration in SOMA. It's less likely that the Fed would engage in outright operations of selling longer-dated treasuries and buying shorter-dated ones, or a reverse twist. Instead, with the objective of not risking any market disruption, we suspect that as maturities give the Fed more money to invest, that they will do it via auction add-ons. So in practical terms, this means that while the Fed won't be actively buying one sector versus another, that there will be less need for larger auction sizes, particularly in the front end of the curve. Now, it's difficult to isolate the impact of this on the overall shape of the curve in the week just past. Instead, we're content to point to the widening of swap spreads as the biggest net price action.
While it wasn't the most pivotal week from a macroeconomic data perspective, that doesn't mean that there wasn't important information revealed as it relates to the happenings in Washington, both the pursuits of increased government efficiency, but also some new information around Secretary Bessent's thinking in terms of the composition of the Treasury Department's borrowing needs, and also what we learned in the FOMC minutes as it relates to the FOMC's thinking about the state of the balance sheet and the potential path forward for QT. The reaction in the curve was most readily attributed to these factors, as the broader conversation around the timing of the Fed's next rate cut and the trajectory of the labor market and inflation was moved to the side, at least temporarily, during this short trading week.
The interesting aspect of the Department of Government Efficiency's push to rationalize the size of the federal labor force is the big question of how that ultimately will play out into the aggregate economic data. Are we going to see a routine headwind of 40, 50,000 jobs for NFP every month, or will it simply be a one-off adjustment? It is notable that the NFP survey week initial jobless claims remained low, coming in at 219,000. That suggested that there was no immediate fallout for the labor market, at least thus far, and therefore we anticipate that forecasts for the February payrolls numbers will be an in-range 150,000 or so. It's also worth making the observation that the market's tone around Trump's presidency seems to have changed over the course of the last 2 or 3 weeks. As we know, the big Trump trade was the bear steepener. That has translated into a bull flattener. Now, there's a compelling argument to be made that all we're doing is unwinding the Trump trade. However, it appears that the market is willing to redefine Trump 2.0, not from a reflationary perspective, but from a DOGE perspective, i.e. an increase in government efficiency and lower federal payrolls. Now, even if the court challenges are successful in preventing some of the more dramatic downsizings, the tone in Washington around the size of the government has clearly changed, and it's reasonable to expect that that's going to flow through to the state and local governments as well. This sea change, combined with a reframing of tariffs as one-time price adjustments followed by an improved deficit position, has really left the market biased to trade some of the incoming headlines from a bond bull perspective. And frankly, we've been somewhat surprised at how quickly this shift has occurred, even as these changes have yet to really impact the realized data.
And there's another dynamic around the influence of tariffs and around the potential job cuts that may be coming on the federal government level and could potentially trickle down to the state and local one. That is, on the one hand, you have tariffs serving as a higher price impulse. Even if that is a one-time price reset, it will contribute to some inflationary pressures, which is a worry from the Fed's perspective. And then you have the ramifications of the Trump administration's labor market policy, both as it relates to actual federal workers, but also immigration and what that means for the overall size of the labor force. Both those factors, higher prices and a smaller labor force, all else equal, point to higher wages and higher prices, but it's the other side of this idea, and something you just touched on, Ian, that's gaining more and more traction in terms of driving an increasingly entrenched dip buying bias in treasuries, which is the negative growth fallout from higher tariffs serving as a tax on consumption, and from a potential contractionary, or at least less expansionary, government contribution to overall GDP. Now, the Fed is not targeting growth. For that, we have employment and inflation, but that doesn't mean the market is not going to respond to more concern on the state of the expansion in the U.S., along with a global outlook that is not faring all that well, and especially to look at real yields that are still north of 2% in the 10-year sector. There's a compelling case to be made that if we're entering a lower growth regime, then rates at these levels, even if off the recent extremes, are still a reasonably compelling buy opportunity.
Part of the flip side of that argument comes from the fact that we're in a broader global rate environment that hasn't really seen the reset back to pre-pandemic levels that one might have otherwise assumed. The budgetary concerns in the UK, the budgetary concerns in Europe, and specifically in Germany have, for all intents and purposes, created something of a floor for European rates, and the Treasury market has been trading in sympathy, at least on the margin. Now, of course, we're having this conversation with 10-year yields anchored at 4.50, not at 5.50 or 6.50. So one could argue that the Treasury market is not actively repricing to a higher plateau. Instead, investors are simply taking a cue from the Fed and are in a wait-and-see mode until there's more clarity from the Trump administration, until the market has a better collective sense of the trajectory of the real economy during the first half of this year. We maintain that while the June FOMC meeting is the first potentially live meeting for a rate cut, that the Fed will probably end up delaying the resumption of normalization until the September meeting, followed by another cut in December. Now, next month's FOMC meeting will be particularly useful in level setting expectations for investors because we'll have the updated SEP, which includes the beloved dot plot. I suspect that the baseline assumption going into the event will be that the Fed lowers the number of rate cuts signaled to just one 25 basis point move this year, or potentially eliminates the rate cut messaging for 2025. Now, that strikes us as an outlier potential outcome because the Fed does want to continue the process of normalization and afford itself as much flexibility as possible. And by eliminating rate cut messaging in the dot plot, the Fed would needlessly be taking that option off the table. At least that's what we suspect would occur in terms of the market pricing. If the Fed signals no more rate cuts in 2025, investors would simply translate that through to 2026 or beyond, and frankly, begin the conversation about whether rate hikes should be the baseline assumption. As it currently stands, effective Fed funds at 4.33 has once again resumed its function as a ceiling for nominal two-year yields. Now, the Fed's discussion about ending QT certainly reinforces some of the more constructive price action that we've seen in the front end of the curve, and if nothing else, galvanizes 433 as the ceiling for twos for the time being. The only way in which we could conceive of that ceiling giving way would be in the event of a material upward revision to the dot plot for this year and next.
And there's another important consideration to take away from the discussion around the end to QT, given what it signals about the Fed's level of concern surrounding the potential for funding market volatility that will result from a drain on reserves tipping too close to the pain point of scarcity for comfort. And so from that perspective, as we've discussed over the past several months, on a risk-reward basis, being more cautious in terms of potentially stopping QT in an environment where the rundown of the TGA will make it difficult to interpret the actual moves in funding rates, it's not exactly akin to feeling one's way around in the dark, but it does create a more complicated backdrop for evaluating the health of the funding market at a time when the level of ampleness of reserves is coming into question, really means that caution is warranted as it relates to the path of SOMA. Now, as we think about what this all means for the Fed funds rate, as has always been the case, the one non-economic data reason that would really trigger a rethink of if yields at these levels are appropriate would be any market dysfunction, especially in the very front end of the curve, as undue swings in SOFR would create ample, no pun intended, other issues in different pockets of the market. And given the Fed's quasi-third mandate of ensuring smooth market functioning, it's certainly a risk that has now reached high enough on the list of Powell's worries to justify a change in the messaging delivered via the minutes.
And the fact that the FOMC has linked the end of QT to the potential disruptions that occur in the funding market once the debt ceiling issue has been resolved has intuitively refocused the market on the potential X date, which at this point we're now estimating as the middle of August, which does give the Treasury Department a reasonable amount of time to cobble together some type of deal that ultimately avoids a missed or delayed payment. Now, our base case scenario remains that the federal government will not default on U.S. Treasuries, and by the 11th hour, as it were, that we will once again see some type of deal that kicks the proverbial can. Now, all of that being said, there's a lot of dramatic changes coming out of Washington at the moment, and there have been conversations about ending the debt ceiling altogether. If and when the debate really heats up, one should expect that to at least be topical, if not a cause that is ultimately championed into the end zone, as it were.
And given that the economic data took a backseat this week, Our main takeaway from the happenings in Washington is somewhat of a fulfillment of the primary conversations we had with clients coming into this year, which was really centered around this idea that 2025 was, sure, going to be defined by the trajectory of the labor market and inflation, and ultimately the Fed's response to those two critical variables, but more importantly was always going to be what the second Trump administration means for policy out of Washington and the feasibility and durability of some of the policy initiatives that we're presently seeing pushed, challenged, and then pushed again. So there is still a potential for a meaningful shift in the federal government's participation in the economy, which in our assessment ultimately adds to our expectation for the balance of this year to be defined by a move toward lower Treasury yields.
And on that topic, one thing that we do have confidence in is that yields will go up and yields will go down, but not necessarily in that order.
A true classic.
In the week ahead, there are a variety of macro events that could ultimately dictate the direction of Treasury yields. First will be the supply considerations. It's the final week of February, and it's also the final round of nominal coupon auctions. We have $69 billion 2 years, $70 billion 5 years, and $44 billion 7 years. Note that because of the timing of month end, everything will be skewed a day earlier. So we see 2s on Monday, 5s on Tuesday, followed by 7s on Wednesday afternoon. We also have the PCE numbers for January. Core PCE is expected to increase 0.3%, but in unrounded terms, we're looking for a 0.25. So that means it wouldn't be unreasonable for a 0.2 to be the ultimate result, or a low 0.3, all of which is reasonably consensus and therefore, presumably, largely priced into the market. We do hear from a variety of Fed speakers, including Lori Logan on Tuesday, who tends to be the go-to Fed speaker for insight on the composition of the Fed's portfolio and any changes that might be looming in SOMA. This is particularly topical given the FOMC minutes and the conversation about not only ending QT, but also about reducing the average maturity of SOMA. Therefore, it follows intuitively that Logan's comments will be closely followed. We'll also get the latest initial jobless claims figures, and as we remain wary of some fallout from the Department of Government Efficiency's efforts in Washington at the moment, we'll reiterate that the most recent week did not see such a move. It's also month-end, and all that implies for duration demand, and as a result, we're reasonably constructive on the Treasury market, with the caveat that a lot of the price action that we have seen recently has been less a function of the fundamentals per se and more readily attributable to the headlines coming out of Washington and Trump's trade war. Adding geopolitics into the mix, it's worth putting on the radar that the U.S. is now actively engaged with Russia as it relates to the invasion of Ukraine, with the ultimate goal of a ceasefire and the end to the conflict. Now, precisely when and how that comes about is certainly a significant unknown, although we will observe that as a theme, one should expect that this will be traded from the perspective of a deflationary impulse. So as the probability of some type of resolution increases, one would anticipate downward pressure on commodity prices, with a special emphasis on the energy sector. And while we do ultimately see the curve re-steepening, the flight to quality and the benefit to duration that we have seen recently implies that the 2s 10s curve in particular will be in a range, and we would look at any pushback to positive 20 basis points in 2s 10s as an opportunity to reset the steepener. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as February comes to an abrupt end at just 28 days, we're looking forward to the full month of March ahead. Poor February, it won't even be close to 30 days until 2028. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.